Hello, I'm Raul Elizalde with a quick take on the markets. Movie buffs might remember the movie called 2010. That was a sequel to the more famous 2001, Space Odyssey. Wikipedia sums up the plot of 2010 as super fast evolution in a world just made habitable. Well, what a fitting description for what 2010 might turn out to be. Movies aside, I think that 2010 is going to be very interesting. Not that we need any more excitement after 2 years of huge volatility. First, the market fell apart in 2008 and early 2009, and then staged one of the most extreme bull markets in memory. So it would be nice to have some calmer times ahead, but like it or not, it seems that more changes are on the way. Two areas that seem ripe for change are interest rates and currencies. Both are related because interest rate differences among countries are the primary drivers of currency moves. This is because when interest rates are higher in one country than in another, then money flows to the one that offers the higher interest rate, which makes that currency go up. This is why the dollar has declined so much. With a 0% target for the Fed funds rate, the US has made it inevitable that investors globally will sell the US dollar and buy other currencies that offer higher returns. This may very well be different in 2010. For starters, the US has cut interest rates faster than any other country, and therefore it is likely to start hiking rates sooner, especially if the economy continues to improve. As I discussed in recent podcasts, many activity indicators show that at the very least, things are not getting any worse, and we may continue to see economic recovery for 2010, which would pave the way for higher interest rates. On the other hand, we have Europe, which is facing a very specific set of problems. If the European Central Bank were to raise rates, that would make life very difficult for countries in the periphery of the Eurozone, Greece, Ireland, and Spain in particular, whose economies are suffering deep economic problems. This will create too much strain on the Eurozone, and therefore rates are not as likely to go up in Europe as quickly as they are in the US. The United Kingdom is going through a rough economic period as well, which makes it unlikely that the Bank of England will raise rates sooner than the Fed. And emerging markets, such as Brazil or China, that were seen as great investments in 2009, had too much of a good thing. Too much money flowing in. This created all sorts of problems, basically asset bubbles in the local markets, which is something that they don't want. So any moves that would strengthen their currencies, such as higher interest rates, are probably not something that they would like to do. Because if the market thought that any of these currencies were to go up, then investors would pour even more money into these countries, making their problems even more difficult to manage. So when it comes to currencies, the US dollar seems to be the one with the highest chance of going up in 2010. And it already started to do so in the last few weeks, in particular against the euro. What does this mean for investors? It means that foreign stocks, which were the big winners in 2009, might be due for some weakness relative to US stocks. It also means that commodities, which are typically priced in US dollars, might fall, because exporters get more of their local currencies when the US dollar gets more expensive. So the conclusion for investors is that at least for early 2010, US stocks might do better than foreign stocks, and commodities might not do very well against other assets. But the most important thing of all is that I don't see any big bombs exploding in the next few months. The world will continue to be habitable for now. For more information, please visit us at www.pathfinancial.net. I'm Raul Elizalde. Thanks for watching.